Ever wonder why some people make millions in real estate while others are stuck with empty properties and draining bank accounts? It's not luck. It's strategy. Want to turn your rental property into a cash flow machine that works 24/7, or are you stuck in a cycle of loss and frustration? Stay tuned, because in the next 15 minutes, I'm going to reveal how to evaluate your rental property to maximize your ROI and avoid the pitfalls that most investors fall into. Here's the truth: too many people dive into real estate thinking it's a get-rich-quick scheme. They buy a property, stick a for rent sign in the yard, and wait for the money to roll in. But guess what? That's where the mistakes start. If you're not carefully evaluating your property's true value beyond just the asking price, you could be leaving a mountain of money on the table. Worse, you could be losing money. Think of it like owning a golden goose but feeding it the wrong diet. It's not going to lay any eggs. You're about to realize that this isn't just about picking up a property and hoping for the best. It's about strategy. Evaluating your property's financials is the first step to making sure you're not just sitting on a potential gold mine while it rots away. Here's the math you absolutely need to know: rental income, property expenses equals net cash flow. Now, that sounds simple, right? But hold on, before you start celebrating, you've got a long list of expenses you must account for to get an accurate picture of your ROI. Let's break it down. You've got your mortgage, property taxes, maintenance costs, insurance, and yes, even those property management fees. Sounds like a lot? Trust me, it is. But don't get discouraged, this is the reality of being a successful real estate investor. And if you want to make money, these are the numbers you have to track. Without them, you might as well be throwing darts at a dartboard and hoping you hit the bullseye. So, should we just start throwing darts at rental listings, or do we get serious and evaluate the property properly? Now, here's where most investors drop the ball: they fail to factor in the long-term growth potential of the area. It's not just about how much rent you can collect today. You need to ask, what's the market like in 5 or 10 years? Is the neighborhood improving? Are there any infrastructure projects in the pipeline? Don't just buy because it looks nice. Buy because it fits into the bigger picture. If you want maximum ROI, you need to think ahead. The wrong property can quickly turn into a money pit, and you'll be stuck wondering what went wrong. But here's the million-dollar question: how do you truly know if a property is right for you? How do you ensure that your investment is going to pay off long-term? I'll tell you exactly how in just a second. If you want to learn the exact step-by-step process to evaluate rental properties like a pro and start building real wealth, you need to take action now. This is just the beginning, but your journey toward financial freedom starts with these decisions. If you want to dive deeper into strategies for maximizing your ROI, check out my next video, where we break down the top 5 mistakes most investors make and how to avoid them. Don't miss it. Let's get you on the path to financial freedom. See you in the next video.